in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
Warren Buffett is a strong believer that the way to create wealth is to make sure, first and foremost, that you preserve your wealth. As a result, today I'm focusing on 5 strategies that are going to make you money in a bull or bear market. I recommend checking out all of them because the best way to save your capital is to spread your risk between a few good strategies. Hi friends, my name is Mize and I'm a hedge fund analyst turned entrepreneur. And on this channel, I go through the top investments in Web3 and decentralized finance. First is Anchor Protocol. Anchor Protocol is on the Terra Luna ecosystem, and for holding UST and depositing it into Anchor Protocol, you currently receive 19.5% APR. It's super easy to get both in and out of Anchor Protocol with the Cato Money on-ramp. Fees are as low as $2 versus trying to go through Coinbase or Binance or something other. The one downside here is the yield for UST on Anchor Protocol will actually be going down to about 15% over the next couple of months. The one additional risk that this protocol has versus others is its use of algorithmic stablecoins, specifically UST. As a result, instead of just the normal smart contract risk you might find in some of these other protocols, you also have some degree of depegging risk. Peg risk is the risk that UST depegs, and in the future, $1 of UST is no longer worth $1 of USD. This is a risk because UST is not backed one-to-one with US dollars. Rather, it's somewhat under collateralized with maybe 30% Bitcoin at this point. To learn more, check out my video on Luna. You can also check out my first video on Anchor where I go through step-by-step how to set up Anchor Protocol because it is one of the easiest and highest yielding farms available. Lastly, if you're really worried about UST Peg Risk with Anchor Protocol, there is a way to invest in Anchor Protocol without necessarily taking on the UST Peg risk. You could use a third-party platform like 100 Finance and take your USDC and borrow UST against it, and then use that UST in Anchor Protocol. If UST was to depeg, you could just go back to 100 Finance, take your UST that is now only worth, let's say, 50 cents on the dollar. You could give it back to 100 Finance and take back your full USDC amount. As a result, you've gotten the 20% on your UST and given it back to 100 Finance for the same amount of USDC. And that extra UST that you got is available to you as needed. Though the return on those earnings might have gone down. So for instance, if you held this for a full year and the UST was to depeg by 50%, all of a sudden your 20% return became 10% because your earnings have gone down, but you haven't been borrowing UST for those earnings. Those earnings you would have to sell into USDC or something else to get back real value dollars. The second strategy that I like is the delta neutral strategy on Mirror. This is actually a pretty difficult strategy to do without some kind of third-party platform that kind of does it for you. Specifically, the delta neutral strategy takes advantage of the long and short farms that are available on the Mirror protocol. This strategy uses Anchor Protocol as a basis for its earnings, and then it uses those funds in Anchor Protocol to borrow mirrored assets and then farm them. Step 1 of the strategy is to earn from Anchor Protocol. This is where you get the basic 20% return. Step 2 is to short the mirrored asset. In this case, you could use Coke or Ethereum or any one of these assets and short it, and Mirror will pay you for it. Third, you'll also buy the mirrored asset. So even if the price of the asset goes down or up when you're shorting it, it doesn't affect you. Fourth, you'll take your mirrored asset and put it into a liquidity pool so that you earn money on that asset as well. All of these things put together could boost your earnings as high as 40%. But this is quite difficult. Doing so requires many steps, and if any of the prices of the assets that you own change dramatically, you could be in some trouble because you're borrowing money from your anchor position in order to institute this strategy. As a result, now there's a really easy way to do this through either broker finance or Aperture Finance. I've used Aperture Finance quite a bit and I found it extremely useful. It gives you really clear and easy portfolio analytics. The analytics that you can see in Aperture Finance clearly show you your P&L. And they will also automatically adjust the leverage that this strategy uses so that you never end up getting liquidated. Now, as always, this is a more complex strategy. So here it's layered one strategy on top of another, and there's multiple smart contracts that are being used to maximize the return on your assets. As a result, there is greater smart contract risk here as compared to just investing in Anchor Protocol, for instance. But yet again, you could use the 100 finance trick to remove the DPEG risk here if you're worried about UST. Next is REF Finance on Near Protocol. Now, this is actually one of my favorite new farms, and I think it'll continue to do well in the near future. The reason is Near Protocol is a fast, up and coming new L1 chain with a lot of money behind it. There's over $800 million of incentives that are ready to be pumped into this ecosystem to further incentivize use. The winners of this massive set of incentives are the users that choose to use this protocol today. The great thing about Near is that it's still quite new and there aren't that many users on it. As a result, you can get in now and take advantage of these incentives. Now, we've seen similar incentives in some other chains that haven't worked out so well. But in this case, Near is backed by some of the top VCs in the United States today. From a technology perspective, Near is great in that it's what Ethereum plans to be maybe a year or more from now. So Ref Finance currently offers between 15 and 25% APR on your stablecoin farms. You can go in and take a look at the USDC farms that exist there and get 20% plus return in some cases. The interesting thing with REF Finance is that there's actually quite a bit of money in there. The farms and pools that exist here have between $6 and $30 million. So you can kind of see that you won't be in a farm with under $1 million, which I would highly recommend against. Here you'll be investing with some of the larger whales that know there's major venture capital backing here. I like that Near is backed by some of the top VCs because if there was really a smart contract issue that caused for a large loss of capital, there's a really, really strong chance that VCs would step in because it's still very early and they have a lot of money tied to the success of this platform. All right, number 4 is Abra. And this is actually a little different from the others in that it's not pure decentralized finance. Rather, it's an app on your phone similar to BlockFi or Celsius or Crypto.com. But I think it's really appealing because it's paying up to 13% on US dollars. And for somebody that's just getting into it, I really like being in somewhat regulated markets to some degree. So if I'm trying to put a lot of money into decentralized finance, I like to spread my risk out between some regulated markets, some algorithmic stable coins, more fiat-backed stable coins, and even different chains. I think Abra is great because it's backed by Amex Ventures and it's paying 13% on your cash. Abra uses TrueUSD as its stablecoin, which is backed 1-for-1 by US dollars. They also pay out weekly. 8% of that is in TrueUSD, and the remaining 5%, once you have 50,000 CPRX, their kind of internal token, is paid out in CPRX. Compared to what I've talked about thus far, the one negative of Abra is that you do have to commit your money for at least the first 30 days. So if you were to put in $10,000 today, you won't be able to get it out for another 30 days. But after that 30 days, you are able to pull your money out within a day. Another nice thing about Abra is that the trading fees are quite low. Many of you might have used BlockFi before and have noticed that the spreads when buying something like Bitcoin or Ethereum were just crazy. It didn't make any sense to choose to buy your Ethereum on BlockFi. But the spreads on Abra are actually very reasonable, and right now they're offering a 1% cash back option on their trades, which really does make it almost comparable to Coinbase Pro. So far, we only talked about stablecoin yields, and I do want to go a little bit further here and talk about something that has a little bit of risk, but is still in the blue chip categories of investments. One of my top investments today. I think in this case, the additional risk of being invested in the blue chips like Bitcoin and Ethereum is worth it because the return is much higher too. Instead of the 20% return that you'll see in Anchor, etc., here we're looking at an average return of 50%. This investment is GLP on gmx.io. GLP essentially allows you to invest in a portfolio that is 50% blue chip coins, specifically Bitcoin, Ethereum, and Avalanche if you're doing it on the Avalanche chain, or Bitcoin, Ethereum, Chainlink, and Uniswap if you're doing it on Arbitrum. And the other 50% comes from stablecoins, mostly USDC, a little bit of USDT or DAI. Now, the great part here is 20% of this is paid out in AVAX or Ethereum. So depending on which chain that you choose to do it on, AVAX for Avalanche or Ethereum for Arbitrum, you'll get 20% in a very liquid and blue chip coin to some degree. The remaining 25 to 30% you'll get in escrowed GMX. Now this is a token that actually still earns fees from the GMX platform. And I can get a little bit deeper into what GMX is. GMX is a trading platform that uses GLP as its main liquidity pool. Instead of each and every person invested in GLP taking on that risk of impermanent loss, the risk is kind of spread between all of the owners of GLP, depending on when they entered. Over time, GLP reduces impermanent loss by trying to rebalance GLP dynamically. Depending on when you are entering GLP, GMX will make it cheaper to buy GLP by reducing the fees if you buy GLP with a token that they have less of. GLP is able to pay out this 20 to 50% because it is accruing 70% of the trading fees off of its platform, GMX. GMX, or escrow GMX, then gets the remaining 30% of those fees. By getting GMX, you're also getting another cash flowing asset. Now, these 5 protocols, in my opinion, can get anyone started in decentralized finance while minimizing the chances of losing money. If done right, you'll make much more than the average professional investor does annually over the last 10 or 50 years. Best of all, you'll be at the cutting edge of what the future of finance will look like. I'm a complete believer in decentralized finance. I believe within our lifetimes, everything we own will become a part of this world of decentralized finance. Every stock, every asset that you own today will be sold on the blockchain in the future. One of the biggest themes of the future will be decentralized algorithmic stablecoins. Check out my review of one of the top growing platforms in this space right here.